So there are different ways you can write the balance sheet identity. And that means current assets plus net fixed assets equals current liabilities plus long-term debt plus total equity. If you rearrange that a little bit, current assets minus current liability plus NFA is equal to long-term debt plus total equity. Shut up. Sorry, I should have turned it off. It's the same identity, it's just different way of looking at it. Sometimes I may be giving you a net working capital and current assets and some other stuff and ask you to figure out net fixed assets. You can also think of current assets just taking this identity as net working capital plus current liability, or current liability is current assets minus net working capital. Again, it's the same thing, it's different way of looking at it. And that's pretty much the stuff we're going to look in the balance sheet in terms of identities. In balance sheet, we will talk about, we will make a distinction between market value and book value of assets. The book value is simple. It is the value that is reported in financial statements. Technically speaking, it's the historical cost minus any accumulated depreciation. Accumulated depreciation like stuff, depreciations, amortizations. Amortization is kind of a different way of doing it. Except for inventory. For inventory, book value is equal to lower of cost and market value. There are different methods to calculate the value of inventory. Again, it's not the topic of this class. Yes. Amortization. It's just a different way of doing depreciation. Sometimes you amortize certain assets, even though they're technically depreciable assets. But the idea is the same. Those are non-cash expenses. When you're looking at the book value of the inventory, it's the lower the cost and the market value. The reason that's even an issue, there are different methods you can use to calculate the value of the inventory. The LIFO, last in, first out, you produce 1 million of these units. Right now you have 100,000 in your inventory. So which one of the 1 million you sold? First in, first out is you sold the ones that came in first. Last in, first out is when you sold the last piece. You can do weighted average, yada, yada, yada. They all create different values, especially in inflationary environments, for the value of the inventory. But when we're thinking about book value, especially accountants, remember they tend to be conservative clients. Let's say inventory, because of maybe life of FIFO, looks like it's worth $1 million in the books, in the financial statements. But if I actually sold it in the market, I could have gotten only 800,000. The accountants being conservative, they view 800,000 as the book value of that inventory. And inventory is special because different way of calculating that cost could create very different values, especially in environments where prices move quite a bit. On the other hand, market value is simple of an asset is the value at which it can be sold without much haircut. I mean, I can sell it Airbus 320 for $10 million within seconds on eBay, but the damn thing probably is worth over $100 million. So if I'm willing to wait, I can sell it at that value. That's the market value. It is almost never the case that market value of an asset is equal to its book value, especially for fixed assets. Market value for equipment and stuff, yes.
Sorry, what's the last one?
Haircut. Haircut. Yeah, I need some of that. It's a fancy term for a deep discount. So if something is worth $100 million and I sell it at 80, that's a $20 million haircut. Okay? For fixed assets, it is almost always the case that market value is greater than the book value, but not always the case. It's definitely the case for equipment that you had for a while, because it has been depreciated. For example, typically computers have a tax life of about 3 years. So within 3 years, you have written off most of the value. So in your books, it can be worth zero. But there are people who's going to pay maybe $200 for this one. I had this Surface, I think 607, the last 4 years. I could probably get $100 for it if I sold it tomorrow. If I bought the new version, I'm going to pay probably over $1,000. But the market value for this is 100. Book value would have been zero. Now, on the income statement side, we're going to define a few quantities. One of them is called let's call it EBIT. This is short for earnings before interest and taxes. We're going to also talk about EBT. Earnings before taxes. It should be kind of obvious that EBT is EBIT plus interest expense. I'm sorry, minus. Suppose you had overall $10 million in net interest expense. So EBIT is before interest and taxes. So EBT says, okay, put the interest back on. But since that's an expense, that's going to be a minus. And it's rare, but we will also talk about something called EBITDA. It says EBIT plus or earnings before interest, taxes, depreciation, and amortizations. That DA, depreciation and amortization, is actually a catch-all word for non-cash expenses. For example, if I have stock-based compensation expense, especially for stock options, to me, it's in its nature, it's a non-cash expense, so I would have included in EBITDA. Of course, EBITDA is equal to EBIT minus depreciation